and welcome. So today we're looking at taxes. This is our second lesson on taxes, and today we're going to be looking at the burden of the tax and how we measure the burden of the tax and whether it's important or not. So last lesson we had a look at what the tax actually does to the industry and the industry diagram. We know that it affects supply and it shifts that supply curve. Now today we're going to have a look at when I was talking about the burden of the tax. So think about when I said the difference between direct and indirect tax is the ability to be able to share the burden of the tax. Obviously with a direct tax, I cannot physically share that burden, but with an indirect tax, you can share the burden of the tax between producer and consumer. And we're going to have a look at how you do that today. So this is a diagram that you should have seen from last lesson. If you're a bit confused, you shouldn't be confused, go and have a look there. I'm not going to spend much time going over how the diagram and how it changes to this in this lesson. So if we have a look at this diagram here, we can see that our price has increased and our quantity has decreased. Now we want to show not only the changes in consumer surplus, producer surplus, we want to show what actually the size of the tax and the impact of the tax on the market is. And the way that we show that is we show the shift from supply to the left to look at the impact of the supply plus the tax, and then we go from the new market equilibrium. So our new equilibrium point where our new supply with the tax is equal to our demand, which has had a movement along the curve, and then we go from the new equilibrium and we just follow this line all the way down to the old original supply line. So essentially we're saying at this price level, this is the amount of tax, right? So at this quantity, this impact of the tax is this. And that tells us the amount of tax for this one level of quantity, right? So the amount of tax is that much per product sold, right? So per product sold. To find the overall tax in the market, you have to times that, because that's the amount of the tax, so the physical price of the tax, and you need to times it by the amount of quantity that's sold, because that's per product and you want to find out the amount of the tax in the market overall. So we just times that by the quantity, and this rectangle here is the size of the tax, right? So you have to remember your core rule. Your core rule to find out the amount of tax in the market is to find the new equilibrium. You go from the new equilibrium down to the original line. New equilibrium, original line. That will be very useful, especially in the next coming lessons where you see how useful it is to just remember that one little rule. New equilibrium, original line, then times it by the quantity. This is the amount of tax in the market. Now we can go one step further than that as well, because remember when we spoke about the burden of tax, it is a indirect tax, right? So the burden of that tax can be shared, and we can physically see how much that burden of the tax is shared by just looking at the consumer and the producer and who pays what amount of this tax. So it's really easy to see which amount the consumer pays, because the consumer pay of the tax is obviously going to be the change in price, right? So this was our original price and this is our new price. So the amount of tax that the consumer is paying is obviously going to be the change in price. So that's this rectangle right here. We can say that this is the consumer burden. The amount of tax that the consumer is burdened with. And then the rest of the tax is obviously paid by the producer, because they're the only other person in the market. And that is this amount of tax right here, the rest of the rectangle. And this is our producer burden. Right? So our consumer burden is the amount of tax that the producer can offload onto the consumer, and that's this rectangle or area of the overall tax rectangle here. And the producer burden is the amount of tax that the producer can't offload onto the consumer. Now remember, we know that the burden of the tax, the original tax, is on the producer because it shifts the supply curve. So therefore we know that the tax is going to be on the producer because it affects the supply curve, and then the producer can offload some of the burden onto the tax onto the consumer. So this is, in theory, what you will be expected to write in your exams for your potentially your 10, your 12, your definitely your 15 or your 25 mark questions that are based upon taxes. You'll be expected to show the tax diagram and show the consumer and the producer burden. And we're going to look through kind of what changes that, what makes it able to pass it on, or what means that they can't pass it on. But equally, the next thing we're going to look at is sometimes you are asked to physically work out the price of the tax, the government revenue, the consumer burden and the producer burden, and that's exactly what we're going to look at right now. So this diagram here is exactly the same as the diagram that we literally just looked at and kind of built together, and we're just now going to work out the consumer and the producer diagram and their individual tax burden, right? So this first diagram here is the kind of one that we're going to look at first and foremost. We had our original quantity price, equilibrium, which was £3, and at that price we sold 100, the market was cleared at 100 quantity, so units of quantity. You don't know whether that's thousands or not, or millions, but we're just going to go with 100 for now. And then a tax was put onto the market that obviously shifted the supply curve to the left, and the price has increased to £3.50. So the first thing that we need to do is just find the area of the tax, right? So exactly the same as we did before, we're just going to go from the new equilibrium down to the original line and across. Now, in questions where you're expected to work out the physical amount of the tax, these three will be given to you, or you will be easily be able to work them out, right? So either they'll be given to you in information, or they'll be clearly labelled on the diagram. You will be able to find them, so don't worry too much about being able to especially find this number here. So we need to work out what is the government revenue from the tax. So how much revenue is the government making from implementing the tax? And the way that we do that is we need to find out the amount per unit of the tax to start off with. That's really, really simple. So we know the new price equilibrium, and we know the price of the producer kind of tax level here. So obviously to find per unit, we just need to minus this number here from this number here, and obviously that gives us £1, right? So our government revenue is going to be the amount that they gain of the tax per unit, which is £1 in this case. But then we need to times that by the quantity here, which in this case we know that our new quantity equilibrium with our tax is 90. So we just need to times it by 90, really simple. So the government revenue here is £90. But we can take that one step further, and you'll have to work out, it's been asked before, especially in section A, exactly how much of this tax is being paid by the consumer and how much of the tax is being paid by the producer. Might be worded as how much of the tax is going to be burdened on the consumer and how much of the tax will the producer burden. But either way, you know that you need to work out the consumer and producer. And from our diagram before, we know that this area above the price, the old price equilibrium to the new price equilibrium, is our consumer burden, and anything else is our producer burden. So it's really easy to work out our consumer burden. All we have to do is see the price difference. So here we've gone from £3 to £3.50, that's obviously 50 pence, and then that is our consumer burden per unit sold, right? So then we need to times that by our quantity, so we have 0.5 times 90, because we need to times it by the quantity that is sold, and obviously that is going to equal £45. And then we need to work out the producer burden. Now, you might just be tempted to be like, it's so easy because you just take away from the government revenue, the overall revenue, you take away the consumer burden from the overall, and that's absolutely fine, you can work it out like that. But it's slightly dangerous because if you've made a mistake here, you're going to make a mistake here, which can lead you to be a little bit misleading. So actually the better way to do it is to work out the producer burden, work out the consumer burden, add them together and see if they equal this number here, and then you know you've got everything right. So it's the same here. This is a really simple example. The difference between £3 and £2.50 is obviously 50 pence. Then we need to times that by 90. So our consumer burden is equal to this, and our producer burden is also going to be equal to 50 pence times 90, which is equal to £45, right? Now, this is a really unique example where you have a tax and the producer is actually sharing that tax burden equally with the consumer, so they pay half each. That is not often the case, it's actually incredibly rarely the case, but I just kind of wanted to show you a really quick and easy example. And now I'd like you to have a go on your own. So I'd like you to pause the video and have a go at these two examples here. What I want you to do is I want you to work out the overall government revenue, then I want you to work out the consumer burden, and then I want you to work out the producer burden. Like I said, my advice to you very much is to work out the consumer burden, work out the producer burden, add them together and see if it equals the government revenue. Then you know you've done everything right. So pause the video, have a go at doing this one and this one, then we're going to go through it together. So, here are our answers, and I've broken them down for you so you can really see where each single part comes from. So in our first example there, we have to work out the government revenue first, right? It's always easy to just work out the government revenue first. So we just did £6.12 minus £4.93 because that's the tax per product, right? So that's the tax that you make per one product. And that's £1.19. So every single product that's sold, there is £1.19 of tax revenue. And then you have to times that by the amount of quantity that is being sold at the tax equilibrium. So the quantity that's being sold at the tax equilibrium, which is 157, and then that should give you £186.83. And then you need to then work out the consumer and the producer burden from that. So we worked out the consumer burden first because it's just the top one, and also it's the easiest one to work out because it's just the difference in price times the quantity that's sold. So we can say that this is the change in the market price. So this is 82 pence was the change. So we know that per product that is sold, the consumer is paying 82 pence worth of tax, right? So for every product that's sold at £6.12, 82 pence of that is you as a consumer paying the tax to the government. And then you need to times that by the quantity, which is 157, which means that you've got £128.74. That is that all the consumers in the market added up are paying that much of the tax. Then what we want to do is work out the producer burden, which was £5.30, which is the old market equilibrium, minus £4.93, and then that gives you the tax burden that is left, which in this case was 37 pence. And then again, you need to times that by the quantity, which was 157. Remember, it's the quantity at the new market equilibrium, so the new supply plus tax equals demand equilibrium. That's the quantity that you want. You don't want the old quantity because you're not selling that much anymore. And that should give you £58.09. And if you add both of those together, that's the way that you check that you've done it correctly. It will equal this number right here, 186.83 pence. And then we'll have a look at the second one. The second one was slightly easier. What this really should prove to you is that it doesn't matter what the numbers are. It's the exact same steps. Just take your time, do the steps. You will 100% get there. Just takes a bit of practice. So in the second example, we do exactly the same thing again, the same steps, just slightly different numbers, inputting different numbers. You will get the same results. So government revenue, again, you just take the price at the new equilibrium and you minus the tax price at the bottom, the producer price, and that gives you tax per product, which in this case is £2.30. So that is the amount of tax that is paid out of the £11.20, £2.30 is tax. right? So, and then you times that by 220, which is the quantity at the new equilibrium, and you get £506. Now our next step is to work the consumer burden out. So again, you just take your 11.20 minus the old market price, which is £10, which gives you £1.20 of tax, which means that for every single product that is sold, you as a consumer are spending, so it's costing you £11.20, but actually £1.20 of that is purely tax that goes straight to the government. Times it by 220, you get 264. Then you need to work out the producer burden. Obviously, if you get super good at this, you can just minus this from this and it will give you this, but that relies on you doing all of that correct. Bit of a dangerous method. You should just work these two out and then take away from that. So then we've got £10 minus £8.90, which should give you what's remaining of the tax burden, which is £1.10 in this case. Times it by 220 gives you 242. Add these two together, you get 506. You know you've done everything correctly. Now, we'll say that sometimes you're asked to work these out numerically, sometimes you're asked to work it out as a percentage. If you're asked to work it out as a percentage, all you have to do is take these numbers, just work out what percentage they are of the £506 here, right? So in some of this example here, the consumer is able to pay most of the tax, which basically means that the producer has pushed the majority of the burden of the tax to the consumer, right? Because the consumer is paying more of the tax than the producer. So basically what's happened is the tax has been put on the producer, and the producer's been able to say, we don't want to pay most of this, we're going to make the consumer pay most of this. And you can see here that the same thing has happened, but to a lesser extent, right? The producer has managed to push on a lot of the tax burden onto the consumer, but not all of the tax burden. Now the question that you should be thinking, fingers crossed, is this question right here. So what dictates this? What makes the producer be able to pass on the burden of the tax, right? What means that if I get taxed, say I'm running like a small business, and I get taxed, I'm like, I don't want to pay that, I want to pass it on to my consumers. What means that I'm able to do that, or I'm not able to do that? Have a pause of the video, have a think about everything that you've learned up until now, way before we went into lockdown. Think about that, and then think about how that might be able to apply it to the tax, and think about what it is that dictates the amount of burden that is being able to shared or pushed or passed on to the consumer from the producer. So the thing that should have come to your mind immediately is elasticities. It's all about the elasticity of demand, right? And we can see that here. So let's start off with it being elastic. If you have a really elastic demand for a good or a service, then obviously what you are saying is that a small change in price is going to lead to a more than proportionate change in quantity demanded. But what does that actually mean? Well, that basically means that if you increase the price by a very small amount, your revenue is going to fall, right? Because the amount of people that are buying your product falls more than proportionally to the price change. So you're going to have a reduction in your revenue. If you're going to have a reduction in your revenue, if you increase your prices, are you going to be able to pass on a lot of your tax burden to your consumer? Well, the answer there should be no, because if you pass on the majority of your tax burden, or even a lot of your tax burden, to your consumer, then they're going to go somewhere else. They might have a lot of substitute goods, or they might just not want to buy your product or service. So we can see that when we have a look at this diagram right here. So we find the tax the same way that we found the tax all the way through this lesson. We go from the new equilibrium all the way down to the old line, and then we go across. And this rectangle here is the overall burden of the tax. That's the amount of tax that's going to go to government revenue. It's a lot when it's elastic. So we then need to work out what is the consumer burden and what is the producer burden. But we just work that out in the exact same way. So we basically just go, we know that the consumer burden is the change in price. So we just take the change in price from here. Don't fall into the trap of going all the way over here and including this little triangle here. That is consumer surplus loss. It is not the tax burden, okay? So that is the consumer surplus loss, this little bit here, but it's not the tax burden. Please don't get confused. And then the rest of the tax is going to be the producer burden. So we can see here that this bit is consumer, and this bit, I'm being lazy, is the producer. And we can see that the consumer burden, when it's very elastic, is much, much smaller, and that can be shown pretty simply when we have a look at a completely extreme case of complete elasticity. So if you have a supply curve here, and you implement a tax, we find the burden of the tax the exact same way, right? So we go from here down to the old line and we go across. Now what happens when something is completely elastic? Well, any change in price, the tiniest change in price, leads to zero demand. Consumers will no longer want to enter the market. So as we can see here, that the incidence of the tax, there is absolutely no price change whatsoever. So the entirety of this tax has to therefore be paid for by who? The producer. The consumer is not going to pay for any of the tax whatsoever. So when you have something that's extremely elastic, the consumer is going to pay a really small part in that in paying that tax compared to the producer. And then we have a look at inelastic. Well, we just find it exactly the same way here. So we go from our new equilibrium. And actually, do you know what? It might be a really fun exercise for you to kind of do this on your own to start off with. Show me the incidence of the tax, who's going to pay more and why are they going to pay more. Pause the video, have a go, and then we'll go through it together. So, you go from the new equilibrium all the way down to the old line, your original line, don't know if I say old lines, and across. And this is the overall size of the tax. Now it's really easy, follows the same rules. We go across here, the price change is the consumer burden, and what's left is the producer burden, essentially what the producer has not been able to pass on to the consumer. So we know that this top bit here is our consumer burden and this is our producer burden. Again, don't go all the way across here. That's not the tax. It is a change in consumer surplus. And again, we can show that by looking at a super extreme case where we have a look at our supply curve here, and then say there's a tax implemented on the market, right? So we have our old equilibrium and we have our new equilibrium, and our quantity equilibrium down here stays exactly the same because it's completely inelastic. So it doesn't matter what the price is, consumers will always pay the same, right? They won't pay the same, but they'll always demand the exact same. So they don't mind either way, like what the price is. Well, they might mind, but it isn't going to change their consumption habits. So we know that consumers pay the price difference, and we can see here that the entire tax is represented by the change in price, and therefore when it's completely inelastic, you are able to pass on the entirety of the tax. So I'm going to leave you with this really final question. Pause the video, have a think about it. In which market is the tax more effective? So in which market, if you were the government, what type of market would you want to tax? Would you want to tax an elastic market, or would you want to tax an inelastic market? Have a pause, have a think, write down your answer, justify it, and then we're going to go through it super quickly as our final kind of close off of a question. So it's a little bit of a trick question. It depends. It depends on what you're aiming to do. If you have a demerit good and your main aim as the government is you want to reduce the amount of people who are in the market, right? You want to reduce the quantity consumed in the market. Obviously you want it to be very elastic because that very small change in price is going to have a huge impact in the quantity demanded. So you don't actually have to, a very large tax is really going to reduce the amount of quantity demanded in the market. So therefore, if your aim and your main goal is to reduce consumption, obviously you're going to want to tax an elastic good. But if your aim as a government is to raise government revenue, then you're going to want to tax an inelastic good, because that increase in price doesn't have very much of an impact on the quantity demanded. So therefore you're going to be in a situation where if you tax a very large amount, then it's not really going to change the amount of quantity demanded, and therefore your government revenue is going to be higher. So depending on what your aim is for the tax depends on which type of market you are hoping the good that you are taxing is. So I hope that's been useful for you. I'll set some kind of questions online for you to be able to have a go at working out some more of these taxes. And I look forward to seeing you next week. Have a good week. Bye!